The surprising truth behind this famous stock market quote. This famous quote from the world of stock markets has been repeated countless times, but have you ever wondered what the true meaning behind it is? In this video, we'll be exploring the surprising truth behind the well-known words, "Don't do anything." We'll look at how this advice can be interpreted in different ways and how it applies to stock market investing. Get ready to discover the real meaning behind this famous stock market quote. So let's get going. What is the famous quote for stock market? When it comes to investing in the stock market, there are a lot of different strategies and pieces of advice that people will offer. Some will tell you to invest in a particular company or sector, while others will recommend diversification. However, one of the most famous pieces of advice that is often offered is simply, don't do anything. This may seem like a strange piece of advice. After all, if you're investing in the stock market, you probably want to act and make changes to your portfolio. But the idea behind this quote is that sometimes the best thing you can do is to resist the urge to make changes. Instead of constantly buying and selling stocks, this advice suggests that it may be better to sit back and wait. This can help to avoid making rash decisions based on short-term fluctuations in the market and instead focus on long-term trends. Of course, this doesn't mean that you should never make any changes to your portfolio. But it does mean that you should be cautious and deliberate in your decision-making. By taking a step back and considering the bigger picture, you may be able to make more informed decisions that lead to better outcomes in the long run. Understanding the context behind the quote. When it comes to investing in the stock market, there are many famous quotes that investors rely on for guidance. However, one quote has stood out among the rest: "Don't do anything." This simple phrase, which may seem counterintuitive at first glance, has been used by some of the most successful investors in history. But what does it mean? And why is it so important to heed this advice? The context behind this quote lies in the psychology of investing. Many investors are tempted to make frequent trades to beat the market and make quick profits. However, studies have shown that this approach rarely leads to long-term success. The more trades an investor makes, the higher their chances of making costly mistakes. The "don't do anything" quote is a reminder to investors to avoid the urge to constantly tinker with their portfolios. Instead, they should focus on a few key investments and hold on to them for the long term. This strategy is known as buy and hold and has been proven to be one of the most effective ways to generate consistent returns in the stock market. Of course, there are times when it is necessary to make changes to a portfolio, such as when market conditions change or when a company's performance takes a dramatic turn for the worse. These situations are, however, the exception rather than the rule. By resisting the temptation to make frequent trades, investors can avoid unnecessary fees and taxes, as well as the emotional stress that comes with constantly monitoring their investments. In short, the "don't do anything" quote is a reminder to investors to resist the urge to constantly make changes to their portfolios. By adopting a patient, long-term approach to investing, they can achieve better results over time. The reasoning behind the quote, the psychology of investing. At first glance, the quote "don't do anything" may seem counterintuitive for those who want to invest in the stock market. After all, investing is all about acting, making smart decisions, and taking calculated risks, right? However, the reality is that investing is not just about making decisions based on facts and figures. The psychology of investing is just as important, if not more so, than the financial aspects of it. The famous quote is based on the idea that sometimes the best decision is no decision at all. This is especially true when emotions, such as fear or greed, are clouding one's judgment. When we're too emotionally invested in a particular stock, we tend to make rash decisions based on our feelings, rather than rational thinking. We may hold on to a stock for too long, hoping it will bounce back even though it's not showing any signs of doing so. Or we may sell a stock too soon, out of fear that we'll lose everything. In these scenarios, the best thing to do may be to do nothing at all. Sometimes, the best investment decision is simply to hold on to your existing stocks and ride out any ups and downs. This is often the case when the market experiences volatility or when a particular company's stock is going through a rough patch. It's also worth noting that the quote doesn't mean that you should never make a decision or take action. Rather, it's a reminder to be mindful of our emotions and to take a step back when we're feeling too attached to a particular stock or investment. Ultimately, the reasoning behind the quote is that sometimes doing nothing can be the best investment decision of all. By taking a pause and avoiding impulsive decisions, we may be able to avoid costly mistakes and make better long-term investments. Case studies of successful investors who follow the quote. Now that we have a better understanding of the famous quote for the stock market, let's take a look at some case studies of successful investors who followed this advice. 1. Warren Buffett, Berkshire Hathaway CEO. Warren Buffett is perhaps one of the most well-known investors in the world, and his investment philosophy is rooted in the concept of value investing. Buffett is known for his patient and disciplined approach to investing, and he famously advises investors to be fearful when others are greedy and greedy when others are fearful. This quote essentially aligns with the "don't do anything" philosophy because it advocates for investors to wait until they see a clear opportunity before acting. 2. Peter Lynch, Fidelity Magellan Fund Manager. Peter Lynch managed the Fidelity Magellan Fund from 1977 to 1990, and he achieved tremendous success during that time. Lynch is known for his investment strategy, which involves researching individual companies and looking for stocks that are undervalued. He also advises investors to be patient and avoid the temptation to make rash decisions. This approach is like the "don't do anything" philosophy because it encourages investors to take a long-term approach and avoid getting caught up in short-term market fluctuations. 3. Ray Dalio, Bridgewater Associates founder. Ray Dalio is the founder of Bridgewater Associates, one of the world's largest hedge funds. He is known for his principles-based approach to investing, which involves creating a set of rules and guidelines that dictate how he approaches the market. Dalio advises investors to stay disciplined and avoid making decisions based on emotions or gut feelings. This approach is aligned with the "don't do anything" philosophy because it encourages investors to stay focused on their long-term goals and avoid getting distracted by short-term market movements. Overall, these case studies demonstrate that successful investors often share a similar philosophy when it comes to the stock market. They understand the importance of being patient, disciplined, and focused on their long-term goals. By following the advice of the famous quote for the stock market, they can avoid making hasty decisions that could lead to costly mistakes. Misconceptions about the quote. The famous stock market quote, "Don't do anything," might seem counterintuitive to some investors, leading to some common misconceptions about its meaning. One misconception is that this quote advocates for inactivity and laziness when it comes to investing. However, this couldn't be further from the truth. The quote emphasizes the importance of not making hasty or impulsive decisions, which can often result in financial loss. Another misconception is that this quote suggests investors should simply sit back and do nothing at all. Again, this isn't entirely accurate. The quote is more about the importance of taking a long-term approach to investing and not being swayed by short-term market fluctuations. Some investors might also interpret the quote as being relevant only to experienced investors with a vast understanding of the stock market. However, this isn't the case either. The quote can be useful for investors at all levels, as it highlights the importance of patience and careful decision-making. It's important to remember that while the quote "don't do anything" might seem simplistic, there is much more to it than meets the eye. By understanding its context, reasoning, and application, investors can learn valuable lessons and strategies to improve their overall investing success. What do you think of our video? Let me know in the comment section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.